Transfer pricing for financial transactions is a critical aspect of international tax compliance for multinational corporations, MNCs. With intercompany loans, guarantees, cash pooling arrangements, and other financial transactions between entities, tax authorities worldwide increasingly scrutinize the pricing of these transactions to ensure compliance with arm's-length principles. This article explores the main types of financial transactions subject to transfer pricing, the principles for determining arm's-length terms, and the current regulatory environment, emphasizing best practices to manage transfer pricing risks in financial transactions. Financial transactions refer to the internal financing arrangements within a multinational enterprise, MNE. These transactions often include intercompany loans, loans provided by one entity to another within the group; cash pooling arrangements, centralized management of group cash balances to optimize liquidity; guarantees, one group company guarantees the financial obligations of another; financial derivatives and hedging, agreements within the group to manage risk exposures. Since financial transactions often cross borders, they attract scrutiny from tax authorities interested in ensuring that the pricing of these arrangements aligns with arm's-length standards, avoiding the under- or overstatement of taxable profits. With increased globalization, the OECD has taken steps to standardize approaches to transfer pricing for financial transactions. In 2020, the OECD issued its transfer pricing guidance on financial transactions, part of the broader OECD transfer pricing guidelines, which clarifies several issues specific to financial transactions. While some countries, such as the US and Germany, have their own rules, the OECD guidelines serve as the basis for many tax authorities, emphasizing a consistent approach to analyzing the arm's-length nature of financial transactions. The OECD guidance covers crucial areas: intra-group loans, cash pooling arrangements, hedging and financial guarantees. Adherence to the OECD guidelines helps mitigate the risk of tax audits and adjustments, as tax authorities can more easily assess the basis for financial transfer pricing decisions. In transfer pricing, the arm's-length principle requires that intercompany transactions are priced as if they occurred between independent entities. When applied to financial transactions, it focuses on terms such as interest rates, fees for guarantees, and other compensatory arrangements that would mirror those between unrelated parties. Creditworthiness of borrowing entities. The standalone creditworthiness of each entity is critical. Tax authorities expect that credit ratings within an MNE are consistent with what third parties would assign. Loan purpose and terms. An arm's-length rate must consider the loan's purpose, term, currency, and any collateral or guarantees, as these factors directly influence the credit risk. Market comparables. Analyzing external market data for similar transactions is essential for justifying the pricing and terms used for intra-group financial arrangements. Intercompany loans are the most common financial transactions subject to transfer pricing. Determining the arm's-length interest rate is essential to avoid challenges by tax authorities, which may argue that rates are too low or high relative to market norms. Steps for determining arm's-length interest rates. Functional analysis. A comprehensive analysis of the loan's purpose, term, and the credit profile of the borrower. Comparable uncontrolled price. Method. The CUP method is typically used to establish an arm's-length interest rate by identifying rates in similar transactions between independent parties. Consideration of implicit support. Tax authorities may assume that an entity's association with a financially stable MNE group can affect its creditworthiness. a concept known as implicit support. This assumption often influences the interest rate, documentation, and support. A robust documentation process should include financial data, credit analysis, and a rationale for the rate applied. This documentation strengthens the defensibility of the chosen interest rate. Cash pooling, where an MNE centralizes cash management to enhance liquidity and reduce borrowing costs, presents unique transfer pricing challenges. Cash pools can take different forms. Physical cash pooling: all cash balances are physically transferred to a central account. Notional cash pooling: cash balances remain in separate accounts, but net interest is calculated on the pooled balance. Transfer pricing considerations for cash pooling. Role of cash pool leader. The cash pool leader, typically a group treasury company, may be compensated for coordinating the cash pool. The compensation should reflect the functions performed, risks borne, and assets employed. Interest allocation. Interest should be allocated fairly, reflecting the contributions and withdrawals of each participant. Interest rates for cash pool participants need to be defensible and aligned with market rates. Risk of recharacterization. Tax authorities may scrutinize cash pools to ensure they are not used to artificially shift profits or mask financial support among entities without appropriate compensation. A financial guarantee within an MNE ensures that one group member supports the financial obligations of another. Transfer pricing for guarantees involves determining the arm's-length guarantee fee, which may be influenced by factors like extent of credit support, provided the strength and nature of the guarantee significantly impact the associated fee. Market comparables. Guarantee fees should be benchmarked against rates charged in similar third-party arrangements. Regulatory requirements. Certain countries impose specific requirements or limitations on guarantee fees. Compliance with these local rules is essential. Calculating arm's-length guarantee fees. Explicit versus implicit support. If the guarantee is explicit, the fee can often be determined based on third-party comparables. Implicit support, however, may not justify a separate fee, depending on jurisdictional interpretations. Risk allocation and fee structure. Tax authorities will assess whether the fee structure accurately reflects the risk borne by the guarantor. A risk-based approach can help align the guarantee fee with market norms. Transfer pricing for financial transactions is a critical component of tax compliance, with complexities arising from intercompany loans, cash pooling, guarantees, and hedging arrangements. To manage these challenges, MNEs should adhere to arm's-length principles and maintain robust documentation in line with OECD guidelines and local regulations. By following best practices, companies can reduce the risk of disputes with tax authorities, ensure compliance, and optimize their transfer pricing for financial transactions.